very excited to introduce you all to Sunstone Capital. Much like the way I did before, again, well-defined problem helps with the solution, right? So I want to start off and just talk about the funding crisis. I'm not going to run through each bullet point, but the principles sound. A study done by the SA SME Fund, before COVID, by the way, so what it looks like today must be even more frightening, showed that there are over 2.5 million SMEs in South Africa, which with a predicted credit gap of over 86 billion, between 86 and 350, which is a frightening number, whichever way it is. Practically what that means is, in an entrepreneurial economy which is trying to develop, it's very difficult for business owners who aren't large institutions to get access to the funding they need. You want to deal with a bank, we've got really strong banking institutions, but 4 or 5 major banks that seem to dominate the whole space. So getting finance is really difficult. They look at you in a very old school manner. It's about balance sheet, it's about credit risk in the traditional sense. They aren't prepared to go granular. And I'll show you some examples of why there's real problems in that. And yes, it does work for them. It's their business model. It makes sense. Be safe, be secure, and take a blanket view. But as a business owner in a growing economy that presents a huge challenge is you actually just can't get access to the funding you need. So even if your business is performing really well, you've got an amazing response in the market, you're ready to double, or even not double, but just expand your assets that you're using, it's very, very hard to get the funding to do it. And that's really where we come in with the Sunstone solution. And I'll just talk about it briefly. Again, it's a 12J structure, and what we do is we invest in rental companies. These companies go and purchase these assets and rent them out again. Sounds complicated, but it's actually probably the most simple thing you can think of. We do the following. Let's say you're a you're a doctor, you're a radiologist. You need some radiology for your lab. It's going to cost you R1 million. Now, for some reason or the other, and I guess we can always talk about medical later, but it is difficult for you to go through the traditional routes to get access for that piece of X-ray machinery. So what do? You're stuck now. And dealing with the banks is going to take you 3 months. It's going to take you ages. You're going to get it much later than you need it. You're going to lose revenue. So what do is we'll purchase the asset and we lease it out to you. We rent it out to you. That's a typical scenario. You get the asset in a much quicker time. You operate it as a radiologist, scan some people, make some money. Very simple. Another scenario might be a commercial fleet vehicle. Let's say you're an Avis franchise. You need to buy a range of buckies, 7 of them. Dealing with the banks is a nightmare. Dealing with the admin around moving these buckies is a nightmare. We come in, we purchase the assets, and we rent it out. And there's a couple of things that I guess really make this a compelling case and a compelling service, and in turn a compelling investment. It's a full asset underpin. We own these assets throughout. And again, when we touch on what we've invested in, we don't invest in weird and wonderful items which are just out there. We purchase these assets, we rent them out in a stable and effective manner. We target niche sectors, we target specific plays in the environment where we see there are gaps in the funding space to generate attractive and stable returns to our investors. And you as a business owner, what you're able to do is take these assets and get the operating yield. If you're an outdoor media house and you repay your asset within 12 months, don't worry, pay us over 3 years or 4 years or just rent it. But you're exposed to the upside, you're the one operating your business, you can make money on that. We just want stable, predictable returns with secure asset underpins. So that's what we do. We allow these businesses to grow, meet market demand, as long as we do so in a concise and responsible manner. That's what we do. That's our fund. Just to maybe go into, waiting for this thing, some of the spaces we've been playing in. Medical asset rentals, I mentioned it. Huge market. Again, I don't really have the time to go into it now, but really exciting. We're able to take a very non-traditional view on backing these assets. I'll just use one by way of example. There was a dentist who was part of a practice, 3 of them turning over 20 million rand a year between the 3 of them. Really well-to-do young dentist. He wanted to go out on his own, open up a second practice. He banks with one of the banks which are known to deal well with these young professionals. They just were taking too long. He couldn't get the machinery he needed. His lease started on his new place. And he came to us, and us through our medical banking partners offered him a solution. We purchased the asset. We started leasing it out at a great rate for him, great rate for us. 5 months down the line, that big bank calls us and says, "Hi, Avi, we'd like to buy the deal of you. We'll pay a premium, etc." It took them so long to do the deal work to realize that this is actually a great candidate. Awesome credit risk, track record, good turnover, good operator, And we were able to pick that up in a much smaller period of time due to the leverages we have. We work with medical practitioners, with practice management companies, etc. And by quickly getting a snapshot and a sophisticated view into how, I guess, the credit risk of our offtake, we were able to provide a speedy solution. That's your medical asset rentals, commercial fleet vehicles, lease these out to the likes of Avis. If you're running a fleet of 1,000 trucks, and every time your truck needs to leave the country because it's doing a trip to Namibia and back, you have to wait and get letters from the bank. It's a disaster. You just can't operate your business in that manner. That's where we play in. Managed Uber fleet, similar scenario. Again, I can't go through each one, but we just play in non-traditional spaces. We work with our partners to understand their business needs, how we can secure ourselves appropriately in that space, build a portfolio of great assets that retain value. We don't target capital growth. We're not investing in a vehicle and hoping it's worth double in 5 years' time. We know assets depreciate. We build that into our models. We just want to earn stable returns, give that as in the form of dividends to our investors, let our partners grow in an aggressive manner or a regular manner for themselves with conservative and stable dividend yields to us and our investors. Just to maybe, how am I doing for time? Cool. Just to maybe run through our model, we target a 7.5% annual dividend, right? That effectively results in, it's paid out biannually, so our investors get a payment in August, they get a payment in February, and what we then do is we run the assets, we collect the rent, we make the money, we split it up as dividends, and we target a 90% residual at the end of our fund life. So what we're doing is we're taking a blended, a diversified portfolio of assets and getting stable yields and letting our investors get the benefit of that. And this is, again, maybe just worth touching on, like this is why 12J is so great. The typical investment return profile associated with this is probably closer to that of a bond or something to that degree, where it's really low risk, we've asset backed, and the investment returns in and of themselves wouldn't be that attractive for a retail investor. Yes, for institutions, yes, for people who have access to this or place in their portfolio. But through a Section 12J enhancement, we're able to provide assets to much needed sectors of the economy, provide attractive returns to investors off the bat of a really low risk profile investment. And I think we've done so well over the last couple of years. The proof of the pudding is in the eating. We've been, and I'm not sure about this year, so don't hold me to it, but Easy Equities, I'm sure you're all aware of it, really disruptive fintech platform, over 500,000 investors. We were the first Section 12J fund that they selected to put on their platform. Last year, they put us on again. We went live as of yesterday, once more. I'm not sure if there are others this year, although I suspect not. And certainly not within our space. And the reason they liked us is we're moderate, we're conservative, it's low risk. You can see the assets. We purchase vehicles, it's a fleet, it's easy to track, easy to understand their current value, their market value, where they are. And I think they've just fallen in love with it, as has the rest of our investors. So our offering's really simple. Not high risk, not aggressive, not the highest returns out there, as you'll see. Attractive returns, certainly for the risk profile that we're playing in. A nice diversified portfolio. There's not one particular hedge. And I mean, interestingly enough, I think our partners like working with us so much that during COVID, even sectors which would have traditionally been hit, we were able to make a short-term plan for some of them, but we already recovered any payment shortfalls. There weren't many, already back on track. And they love us and they're growing. And we're able to provide that service to our partners that they can scale with need, provide that return to our investors, give them dependable, stable yields. And that's how we see ourselves and that's how we play in the market. Just to maybe touch on one or two images that you can see. I can't see where we're up to. So yeah, just to touch on, that's a typical example of an Avis bucky. It's a really cool story. We purchased a bunch of outdoor media assets around the country, and we actually ran a little campaign on them a couple of years ago, 2 years ago, which was, I guess, really exciting and really nice. And I mean, let's talk about that deal for 1 second. That media house. Banks take a view on outdoor media assets. They treat them as scrap metal. It's unbelievable. They can have cash flows for 2 years. They can be well established, 80% fill rate, whatever it is. Banks look at them that way. And the reason from a banking point of view is that something like 76% of the structures in Gauteng are illegal. So it makes sense that they're just saying, hold on, we don't want to deal with this. We were able to do a due diligence on each and every site of the people we partnered with and able to find that they're all legal, track records more than a year, and instead of looking at it as scrap metal, we looked at it at a fair market value. And that helped them grow. Subsequently, they've doubled their team, tripled their number of sites, And they've opened up a separate company now which employs people regularly to flout various billboards around the country. So doing good, getting great yields for our investors and doing great things for the South African economy. Just to maybe talk to the process, who our team is.
We're running out of time.
All right.
And I just want to obviously just ask some question because I've got it from two separate parties and they want to talk about on if there are defaults, how do you repossess the assets? And during COVID, which I think you alluded to, did that affect your returns and dividend payments to investors?
Great questions. Okay, so obviously it differs on an asset-by-asset basis, the collection process and policy, but we take a lot of security. So not only do we own the asset and have a right to it, we, in other risk cases, we take additional security on all the rest of the assets. So for us to collect something really easy, it's in our name, we own it. These are all movable assets by and large. So there aren't things that you can really just get away with. It's not hard to transfer ownership. We maintain the ownership, we just run a collection, but we've never had to. Over our entire, fund life, we've never had one actual default. It's really well controlled. And just, to touch on your point, the COVID side, what do we do with these payment holidays? We had two of our clients who requested a payment holiday. It didn't affect, we priced in interest onto their repayments. We built it into the model. They've actually repaid us sooner than we expected. Had zero effect, from that point of view on our investors.
Good. So, Abi, how much are you looking to or targeting your capital raise for February?
So we're trying to target a 25 million rand capital raise with a max of about 50 million. Thereafter, we're going to be introducing debt as well. So,
good. Thanks, Abi. Thank you very much for again participating. Abi Gordon, Sunstone Capital. If you need to get hold of him, I'm sure you can get him on Sunstone Capital website. And there's a very quickly, and I think this is something. What happens if something happens to the fund manager? And I think this would be probably a risk across all funds. Do you want to just talk about it in your fund?
Yeah, absolutely. So first of all, fortunately, the fund manager isn't where the RP sits alone. Maybe that's where the team comes into play. You've got a management team behind the fund. I'm not that smart nor that brilliant. I do a lot of work. I do a lot of running around, but the truth is there's a strong support structure behind every fund, and that really de-risks it. And all our contracts are locked in. So if I got hit by a bus on the way out of here, all our contracts will continue running. Our accounts will keep on collecting. Maybe new deal flow, Jeff, you might have to take over a little bit. But other than that, I think you'll be fine.